Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today we have Michael Cow, Albert Marko, and Tracy Shuchart. We've had quite a week, and we're going to get some big thoughts today for Michael. We're talking about economic divergence, a piece that he did some time ago called Dippin' Dots, and we're going to kind of go into some detail about some bifurcation that he sees in the U.S. market and global markets. We're going to talk about geopolitical risk with Albert, with the Mexico election, the India election, some China stuff, and a bunch of other things around geopolitical risk. And with Tracy, we're talking about gold, silver, crude, and really anything else that comes up. There's a whole lot happening in commodities right now. So guys, thank you so much for joining us today. I appreciate it. Michael, you are not an easy guy to get a hold of, so I really appreciate you taking the time for us today.
Thanks for having me back. It's been a while. Good to be with y'all.
It has been. It's really great that you're back. So I love our discussions. You're obviously a big thinker, and you did a piece a while ago called Dipping Dots, where you looked at some key bifurcations in markets. The first is with the US, you talk about haves and have-nots. The second is between the US and kind of the rest of the world. So can you talk us through the premise of Dipping Dots and how you came to the conclusions that you come to?
Sure. Okay, so I wrote that piece in February, shortly after what I call the December rhetorical pivot. But before I go into that and the bifurcations, I'll take a bigger picture step back and talk about a piece that I wrote in the middle of last year called the Four Horsemen of U.S. Economic Resilience, right?
I remember that.
And real briefly, the four horsemen of U.S. economic resilience are: one, I believe that there is a structural and demographic reason for why core inflation, mainly labor and shelter, have remained sticky and will remain sticky, to make that last mile down to 2% very difficult. Number two, the biggest horseman, if you will, is the fiscal tailwind. And I love to use that mental model that we're in this vodka Red Bull economy where, the fiscal side of things is basically the Red Bull, and it's completely counteracting the monetary depressant that the Fed is trying to administer. And as an amateur mixologist, I can tell you that if you have two mixologists trying to make one cocktail, that results usually in a pretty bad cocktail. Sure. Ultimately. The third horseman of U.S. economic resilience is relative rate insensitivity, both at the consumer level and at the corporate level. So, as we all know, the U.S. homeowners haven't really felt the rate impact yet because we have a 30-year mortgage, unlike much of the rest of the world, like, for instance, Canada, Europe, Australia, et cetera. Also, on the corporate side, only 25% of total corporate debt is floating rate versus about 75% in Europe. So that's a big comparative advantage, I would say, in terms of resilience. And number four, topic that we're going to all talk about is relative energy independence, right? So as a country, the U.S. is the largest exporter of oil, producer of oil in the world right now. It's not going to last forever, but for now, it really cushions the U.S. as a country. And especially when you consider the twin effect of rising commodity prices, which are dollar-based, and a strong dollar, that has a double whammy effect on huge net importing countries like China and Japan, right? So these four factors really made me think, okay, well, where are these schisms going to arise? And so the first one that you talked about is within the US, and I wrote in that Dipping Dots piece, I said, look, there's two key bifurcations, right? Like within the US, I'll call it, there's a bifurcation between the haves and the have-nots. And then within that bifurcation, I'll split it between consumers and corporates, because on the consumer side of things, you have to basically break it down between essentially, high income and lower income deciles, right? And as we all know, at the lower income deciles, much more of one's income goes towards consumer non-discretionary expenditures like food, energy, rent, etc. And so I think that is a big problem. That's why inflation is the most pernicious regressive tax of all. It really, really kills the lower to middle income class, the have-nots.
We just saw, I think yesterday, the day before, American Airlines flight attendants rejected a contract that raised their pay, I think 18% or something. And so, these are, middle income workers, and they want a greater than 20% pay rise. And, who can blame them when we look at just food inflation alone? So you're right. This thing doesn't feel like it's close to being over, regardless of what we're told about headline inflation.
And you got to love how some of the academic bobbleheads spin it. I think Paul Krugman notably had a post a while ago saying, "Oh, well, the X food, energy, rent inflation is well behaved. We have solved inflation." And I'm like, well, that's a wonderful result for people who don't eat, don't pay rent, and don't use energy. That's great. So that's within the consumer side, right? But then on the corporate side, there's definitely a difference between the leveraged versus the unleveraged sectors, right? So we all know the problems that are occurring in CRE and the resultant cracks and fissures in CMBS, right? But these are usually operators that have that are over their skis from a leverage perspective, and or did not hedge their interest rate risk. So there's definitely that bifurcation, and it tends to also be along small cap versus big cap lines, right?
And let me give you one more, Michael, to reinforce that. I run a small company, very small company. We applied for our employee retention tax credits 2.5, almost 3 years ago now. It was one of the first policies that the Biden administration came out with, and it's a 6-figure number for us, and we still haven't received that funding. So there are, we hear a lot about fraud with PPP and ERTC and all this stuff, but there are real legitimate companies who have still not received their employee retention tax credits from 3 years ago. I mean, this is how strapped small companies are. In addition to the issues that you're talking about, the funds that the feds said that they would provide for us to keep people employed during COVID are still not forthcoming. Well,
the absurdity of it all is that I personally know some data points where, a large law firm that I know of, for instance, got 10 million of forgivable PPP loan while their business was just booming. Yep. It's just maddening, right? To me, as a taxpayer, it's just absolutely maddening to me to see that. But it's rampant, unfortunately.
As a legitimate small business, it's really hard to see that.
Yeah,
because we're lumped in with the people who are booming and getting tens of millions of dollars of federal funds.
Yep. And it's one last anecdote on the consumer side of things, right? I mean, it's very much a K-shaped recovery, right? Because despite all of the monetary tightening, right, this fiscal tailwind has been so huge, it's counteracted that and then some, right? Yes, there was a very interesting chart I retweeted last week that basically showed how, even with Fed funds at 5.5%, we've essentially have like an all-time high in terms of looseness of financial conditions. You've got asset prices to the moon. And just anecdotally, I have a good friend who runs he's run a family luxury watch boutique in my neighborhood for decades. Yeah, for decades. Okay. So, and he's always kept to like the one shop. Well, I think his business is booming so much right now that he has tripled his floor space and opened a second branch. It's after decades of running one boutique shop. It's just totally crazy, right? It's such a K-shaped bifurcation.
Right.
Yeah, and so that's the first bifurcation. I don't know if you wanted to dwell on that or go to that second bifurcation I talked about.
Yeah, absolutely. Let's dig into that. So you talk about leverage versus unleveraged, big versus small, have-nots versus the haves. So when will we've already started to see this divergence a little bit, but when will that pain really start to hit? Because we're seeing it a bit, but I'm not quite sure we're there yet.
Well, I think we got a whiff of it in this last week because what I see happening is like Tracy, I pay a lot of attention to oil specifically. And I think with oil, I've been very, very cautious on oil for the last like year and a half, and saying that like at some point you've got this double whammy effect of high commodity prices and high dollar, right? And the problem with forecasting when demand drops, it's very, very difficult to do that in the commodity world, right? It's much easier to figure out what supply is going to be. And we all know that supply in the oil market has been kept artificially inelastic by these unilateral cuts by OPEC. And so with all of these cuts being extended, notwithstanding, the problem I see is that when you see a sudden downward demand shift into an inelastic supply curve, there's really no leading indicator to show you that. By the time a forward curve goes into contango, you've already been bludgeoned to death on flat price. And so when what we're seeing, I think, is if you see like some of the aggregates like distillate and diesel demand really faltering, I think that's a real sign that what I call the last bulwark of consumer non-discretionary demand is starting to crack a bit. And you're seeing, I think the commodity markets are the biggest tell of that.
So I just want to make sure I understand this. We've got crude that's been soft for the last week or so, right? But we have other commodities like copper, although it's come off a little bit, still pretty elevated. We've got precious metals still elevated. So what else in the commodity markets? Because what I'm thinking also is we're seeing shipping rates, Asia to US, they've really spiked over the last few weeks. So that would tell me that there's a lot of demand for manufactured goods from Asia coming to the US as well, unless there's a cutoff of say, container ship supply. So help me understand that a little bit.
I don't want to steal Tracy's thunder on this, and we may have differing views. I don't know, but my view is that I don't want to be long pro-cyclical commodities here, because I feel like the world especially the rest of the world, and that's the second bifurcation that I've yet to talk about.
Yep.
I think the rest of the world is starting to go into slowdown mode, and I don't like to be in pro-cyclicals with respect to, in fact, like my most successful shorts this month have been basically oil through XOP as a proxy, FCX as a proxy for copper, and even a silver short. But what all three of them have in common is that they have an element of pro-cyclicality by way of industrial demand, and so and that's why I shorted them. I've since closed them out, waiting for a bounce, but I probably wait for a bounce to reshort.
But the Chicago manufacturer, the Dallas manufacturer, the New York manufacturer index, they would all support what you're saying. So are you saying, do you feel like we're in the early stages of that? Or do you feel like we're pretty far into it?
No, I think we're early stages. I don't think we haven't seen a recession. We really have not.
Right.
Right. I mean, they're revising down the GDP projections, but they're being revised down from a ridiculous rate. And then, there was a lot of, I feel like the market put a little bit too much weight on like the soft jolts data. But I mean, when you take a step back and you look at how low unemployment is, I think the Fed is truly boxed. I don't think the Fed, let's put it this way. I was responding to Bob Elliott's quote the other day, and I said, he was talking about like this is kind of like a Goldilocks type of economy. And I said, well, I almost characterize it as almost like potentially an anti-Goldilocks, because the economy is just weak enough to potentially begin to cause earning misses across the board, but is just strong enough to keep core PCE sticky, such that the Fed really can't cut without fears of reigniting inflation.
Well, that's what the ECB just did, right? They just cut, and inflation is still above their target rate. So
yeah, they cut while they increase their forecast for inflation.
It's unbelievable.
But I wrote a piece about this. I called it the Battle of the Bats a couple of weeks ago, and I basically talked about the decision matrix. If I'm putting myself into the shoes of each central banker around the world, and factoring in their decision matrix, in pretty much every circumstance, the less bad choice for the central bank is to cut before the Fed, because again, going back to this notion of U.S. relative economic resilience, we have an economic divergence, and this second bifurcation that I wanted to address is between the U.S. and the rest of the world. We talked about the intra-U.S. bifurcation, right? But the U.S. in aggregate is still stronger than most of the rest of the world, and so yeah.
Before we go into the rest of the world, I want to a few things. First of all, you talked about the potential of a lot of earnings misses. Now, earnings over the last probably 3 years, and this probably peaked in 22, earnings growth was really built on the back of inflation and fiscal stimulus and wage rises, right? So earnings expanded because those companies could build more margin because they had all these tailwinds. And now we see inflation slowing down. We see wage rises slowing down, and so on. So I think what you're saying with the potential for a lot of earnings misses, first of all, it makes a lot of sense to me, but I think also it would take a lot of people by surprise, because we keep hearing that this is a Goldilocks soft landing environment.
Yeah, that's right. Again, you have to pay attention to what pro-cyclical commodities are telling you, I think. And this could just be a bull market sell-off, or it could be the beginning of something much more dangerous. And so exactly.
Yeah,
so
Tracy, what are your thoughts on Michael talking about oil being softer and some of his more successful shorts this month? What are you seeing on the demand side of of oil right now, and what's your outlook?
I think there's a lot of mixed messages that's going on with oil right now, specifically with the OPEC decision, and we can get into that a little bit later. But definitely, I feel like, and I'll use Michael's word bifurcated, because
Yep.
what we're seeing is, we're seeing demand pick up in some areas, while we're seeing kind of some softness in this market in other areas. And so I think it's kind of a push-pull as far as that's concerned. Really, if we look at the product market, that's where we're really seeing softness right now, particularly in the US, and with the manufacturing PMIs and all of that coming down, we definitely seeing some softness there. But, if we look at, Spain, for example, their numbers just came out. They're like up 26% year over year in diesel demand. So I feel like it's very spotty, let me put it that way, where we're seeing demand pick up in some places and obviously demand kind of softening in other places. US obviously is a huge consumer, world's largest consumer. And so all eyes on the US right now, obviously.
Okay, great. And then Albert, I wanted to ask you about Michael's statement about the kind of the vodka and Red Bull with the fiscal and monetary stimulus. Can you talk to us a little bit about as much as you want, about what Yellen has been doing and is doing, and how that is playing either with or against the Fed, and how long can that last?
Well, I think that I've said this repeatedly, I think Yellen's actions are completely geared towards re-electing Biden. And what she's been doing, is simply put, is she's eliminated QT by stealth QE. And it shows in liquidity in the market. I mean, the tech's raging. Oil, going to Michael's point about oil shorts, some of these, over-exaggerated geopolitical risks, specifically for oil, is fantastic shorts. And I think the Fed knows that, Yellen knows that. They use oil tanking to rally bonds and rally tech, and I mean, it's the same script over and over again. It's like nobody's learned for the past 2 years of sitting there watching it on the screens.
Yeah.
By the way, Albert, I wanted to just say that I'm curious what your thoughts are on this, but geopolitically, I've been saying since I think sometime in the fall that I think the true geopolitical risk to oil is to the downside, not to the upside, because the standard knee jerk is to buy oil when there's Middle East tensions or Russia tensions. But the fact of the matter is that this is not the oil market of 1973. And what we have is a huge supply overhang from OPEC, where Saudi Arabia has basically gotten themselves into a corner where I don't really see a viable exit strategy for Saudi Arabia here to back out of these cuts, except for, let's say that Trump gets elected in the fall. If that happens, I see Q1 as a very big geopolitical risk to the downside for oil, because I could see MBS saying, hey, I've always wanted a security deal with the US, and in return, I'm going to basically restore 2 million barrels to the market. What do you think of that? What do you both think of that, Tracy and Albert?
Well, from my view, you start talking about a sub $65 WTI, then you're gonna have problems in the U.S. for shale production. So I think they're really wary of that. It is a risk, certainly. It's a risk, exactly for the points that you mentioned. When it comes to Trump being reelected and what the Saudis could possibly do, the problem I have with that theory is Trump has said time and time again he wants to cut rates to stimulate the economy, which would bring back inflation, and God knows what that would do to commodities. So I think there's a lot of variables that we'd have to sit there and assess and go over in case Trump wins. And one is the Saudi aspect of it, but the other side would be a Treasury Secretary under Trump that would want to cut rates drastically.
But
Yeah,
isn't,
but you also remember what Trump did in Q4 of 2018. I call it the Trump rug pull for a reason, right? He pulled us out of JCPOA, promised no waivers, got MBS to flood the market, and then granted 11 waivers and absolutely collapsed the price of oil. So
Yeah, I mean, I mean, both Biden and Trump are very wary of the price of oil as it affects, consumers in the U.S. And they're certainly going to do whatever trickery they can to keep it capped, under 95 and probably above 65. But yeah, 100. I think Trump could just throw all the, game plan out the window and collapse the price of oil to like 50, 48, something drastic like that. And then, yeah, we would have a pretty good problem in the market.
and now, but you're saying that Trump is saying he'll cut rates, but aren't we headed that way anyway? I mean, that's what markets are asking for. That's what people, so I think it's a pretty safe statement for him to say that he wants to cut rates, because that's
Yeah,
what.
but how fast and how much, right? I mean, sure, the Fed's going to cut rates maybe once or twice this year just to sit there and propel the market just going past November. But if they have another inflationary wage come 2025, they can't keep cutting rates. It's impossible. I mean, they're going to sit there and have another surge of inflation, over 6% again.
Yeah.
I might be one of the only people that still believes that the Fed is still relatively independent. It's not up to Trump ultimately. So if as long as, I mean, I feel like if there's any Fed chair who has a shot at actually being a pretty apolitical entity, is Jay Powell. He's independently wealthy. He's said repeatedly that the Fed is at a juncture that's more important than it's had in decades, and he needs to see this through. So unless he is fired, I think he's going to try to get inflation down. That's why I still think that we're in H4L mode.
Yeah, but when you say he's independently wealthy, he's supposed to divest from all holdings, yet he has, God knows how many millions under Larry Fink. So how independent can he possibly be when Larry Fink and Janet Yellen talk, behind the scenes every single day? He's supposed to divest, and he never did. So, where's his wealth at this point? And whose hands is his wealth in? And how does that affect his bias towards Fed policy?
Yeah, but we can talk about Congress. We can talk about all the department secretaries and stuff too. I mean, I know he's.
Yeah, but we can do that. But the fact of the matter is, Powell dictates Fed policy and rate cuts and whatnot.
You're right. Yep, you're right. Tracy, what are your thoughts on oil? What Michael lays out of a potential Saudi security guarantee and the price of oil and that sort of thing?
Well, I think we're getting too ahead of ourselves right now, to be honest with you, right? And so what I'm looking at right now, I mean, the market is, in my opinion, unless something drastic happens, we're still in this higher for longer, right? And so even if we're talking about softness in the oil market at $75, which is well above historical norms.
Yep.
And to be talking about, there's such softness in the market and we're at $75 is like, I just like to remind people this is well above where we have been, except for occasional spikes in the market.
Well, the sentiment in the telegraph is that it's soft, but you're right, it's not historically soft.
Right. And so, and I think, oil companies are making money at this price, and I've stressed, I don't want to see oil over 100. I think this is bad for everybody. I've said that, but if we could just maintain a kind of a sideways market, it'd be good for, it'll be oil companies, it'll be good for markets, it'll be, and that's kind of what we want to see. We don't want to see spiky oil prices.
Right. Right.
But I guess how do you see MBS exiting his unilateral cuts of 3 million barrels per day?
I think that he's going to have a very difficult time doing that. And, they did put a caveat out that said, after Q3, we're going to, get rid of the voluntary cuts from the 8 countries. The caveat was that if the market is not going our way, in other words, those cuts will be taken off the table essentially. And so they're giving themselves essentially a lever. So I think it's going to be very difficult for them in general to start, tapering off those cuts that they have planned. And again, they already warned us that that is just a possibility, and according to market conditions that can change. You have to remember, Saudi Arabia has a lot of projects. You've got NEOM. They want to transform the country into a world-renowned tourist destination. Got a lot of they got a lot of projects that need a lot of money right now. Oil, they need Brent really at $90 to even, get their budget in control with all of the spending they're doing. That's why we just saw them have another offering for Aramco, right? And then we saw, and they had another bond offering, right? Dollar denominated bond offering. I mean, they're trying to get as much money as they can because, oil is soft. It's not soft, but it's below what is budgeted for the country and what their projects are.
Right. Hey, let's move on to the rest of the world stuff. I know we've covered actually quite a bit of it so far, but Michael, in the rest of your piece, you talk about economic divergences between the US and the rest of the world becoming more stark. And a lot of that has to do with the power of the dollar and the power of the Fed. Can you walk us through that?
Actually, I would turn it around. I would say that because of the aforementioned four horsemen of US economic resilience, right? That in turn is what drives policy choices that are divergent from one another, which in turn drives the rate differentials, which in turn drive what I call US dollar wrecking ball 2.0. I like to say that US dollar wrecking ball 1.0 was, in 2022 when we first had inflation rear its ugly head as and I think oil was perhaps the spark that lit that conflagration, and then it kind of raged out of control. And then I predicted back then, in 2021, I said that oil typically, it's been there's been an inverse correlation over the last several decades between oil prices and the dollar. But I said that this time it would be actually a positive correlation because high oil prices, ironically, would keep the Fed, make the Fed out hawk the rest of the world, which it did, which led to the DXY going to 114. And then dollar had a pretty sharp sell-off correction. But I think we're still potentially in the stage of US dollar wrecking ball 2.0, where it's not the Fed out hawking the rest of the world anymore. It's the rest of the world out doving the Fed. And we're seeing it. We saw the Bank of Canada yesterday. We saw the ECB today. Japan is still basically, even though they've said that they're relaxing yields on JGB, I remain unconvinced that they can just let the JGB yield go to whatever market determined yield it can. And then of course we've got the basket case that is China. I think China's got much bigger, deeper structural issues where they're truly stuck in.
You're not allowed to talk about that. I'm kidding.
Yeah. Yeah. So I mean, I just
please
think
tell us about that. Talk about real estate, debt.
Well, it's demographics, it's real estate. It comes down to a top-down GDP targeting economy, right? Which has misallocated capital for decades, and all you see are the nice shiny cities, etc. But they're underneath the hood. There is quite a bit of rot, and I had a podcast on my Chaos Theory podcast a couple of weeks ago with this China specialist, Brian McCarthy, who ran a China devaluation themed fund back during that 2015-2016 devaluation. And I something he said really resonated with me, which is, if you think about the way the Chinese economy is set up, it is set up to extract value from the consumer and to fund the top-down state directives, right? And so these top-down state directives have now they've been kind of uncovered as 100 million, unoccupied homes, a lot of failed One Belt, One Road projects, etc. So they're really stuck because the consumer there has been eviscerated. I think like 70% of Chinese households, household net worths are real estate. So do they go and reinflate a sector that is clearly a zombie sector, but or I mean, how else are they going to reignite animal spirits for the consumer?
The way they could do that is discredit other asset classes in China. So keep people from buying gold, keep people from investing too much in the stock market, make that illiquid, keep people from, and then forcing that money to go into real estate. That's one of the only ways I know of that they can reflate that, or
But do they even want to reflate it? Because it would completely be antithetical to their three red lines policy, which was to actually prick that bubble.
Right.
So
You're absolutely right. And it is financial repression as an economic policy, right? And it has been from the 1950s into the 60s, and people who don't know modern Chinese history don't understand this. But from people building, steel mills in their backyard in the early 60s until today, we talk about the wealth effect and Chinese people being brought out of poverty, which is true. But, at the same time, there's huge financial repression of that wealth that's been gained. So, can we say we're dramatically different here in the US? Yeah, we're different. It's a different type of financial repression. But what's happening in China and has happened in China is dramatic. It's really dramatic.
One thing that I think is a theme that's also interesting and worthy of discussion is that, if you think now let's talk geopolitics for a little bit. I mean, we opened up, Nixon, Kissinger opened up China, and then Clinton's big pivot towards China. The hope was that, by showing them the fruits of capitalism, that they would become a more democratic society, right? Well, we've actually seen them go the opposite direction with the ascent of Xi, right? You and I both agree Xi is cut much more from the Mao cloth than Deng Xiaoping's capitalist reforms. And so what's actually happened, ironically, is that because of their unfair trade practices and IP theft, and as a result of this autocratic state-run industrial policy, it's now forced us to adopt more top-down industrial policy as a counter, as a geopolitical counter. I'm talking about stuff like the CHIPS Act, export controls, things like that. So it's that strategy has backfired. We've become more top down as opposed to China becoming more bottom up.
Yeah, yes, I agree with you, but I'll also say that because China has been a convenient manufacturing center where regulations, US level regulations could be ignored effectively, and we outsourced our pollution and our bad regulatory environment and everything to China. It allowed us to have this utopian regulatory regime that really hamstrings manufacturers. And so instead of, say, the CHIPS Act or the IRA or whatever, deregulation could have been, it's too late now, could have been a very interesting way over the last 20, 30 years to compete with China, because now they are not as affordable as they were 20 years ago. And places like Malaysia, Thailand, Philippines, Eastern Europe, parts of the US are as cheap or cheaper than China on an hourly rate cost. So, you're right. There has been this theory coming out of think tanks and academia that we don't have a strategy, right? The US doesn't have a strategy. We do have a strategy. Our strategy is capitalism, right? Our strategy is efficient markets. That's our strategy. Strategy is carried out by companies and private sector individuals. That's our strategy. And so government centrality to strategy, not necessary. And I'm not a libertarian, but I don't think that, we need the IRA level and the CHIPS level of activity if we had kept regulation as low as it should have been, knowing that China was where it is. So let's move from your China geopolitical risk to our China geopolitical risk. Albert, what's your top level assessment of China as a geopolitical risk? And we've seen US-China war rhetoric really ratcheted up over the past few weeks. And honestly, I'm really tired of it, but maybe you have a different view. Maybe we're just on the precipice of war with China. But how big of a geopolitical risk is China? Do they want to see a change from the status quo, I guess, is the entry level question of that.
No, they don't want to change the status quo at the moment. They don't have the ability to. They have vulnerabilities across their economy, across food security, water security, all over the place. I mean, everyone sits there and talks about Taiwan being a risk for Chinese invasion, but I mean, I'm more concerned about the Indian border with the Chinese, more so. I mean, Taiwan. It's like every time someone's bored in a think tank, right, or a financial firm, and needs to write something up to talk about geopolitics, the first thing they take is Taiwan being invaded by China. It's so
100%.
Yeah, it's just so overblown, over exaggerated. People in Taiwan just completely dismiss it, and everyone seems to just sit there and push aside all the risks to China, as if like the Chinese would just waltz in there in 1 hour. No joke. Someone actually said that. Some geopolitical expert said that it would take China 1 hour to take all of Taiwan. 1 hour. It takes an hour just to get onto the beach and into the roads through the mountains, let alone go through the entire city. It's just comical at this point. And I'm taking the entire Taiwan invasion thing as a marker to that anyone that brings it up and says it's happening in the next 6 months or 12 months or whatever, I just immediately discount as a fraud.
Yeah, they're fundraising for DOD is effectively.
Yeah, I mean, that's fine. I don't take those guys seriously anyways to begin with. But the think tank guys like the CSIS and, other, Brookings and Heritage and whatever.
China's MO, just because I want to ask both, you, Albert, and Michael, China's MO, from my perspective, is this. You pick on the weak link. You pick on the weak regional potential adversary, Philippines, Vietnam, Vietnam in 1979, Philippines over the last 3 years, India, which isn't weak, but there's a very, I would say, race-based motivation for China to focus on the Indian border. Cambodia, where they've effectively taken over a lot, Myanmar, where they're taking over a lot. So they pick off their weak neighbors and they bully their weak neighbors. That's the status quo change that they want, but they can't afford, I don't believe, to have a dramatic change of status quo by taking over or taking on powerful neighbors or powerful adversaries. Is that a fair conclusion?
Yeah, exactly. And let's just be honest. If China could take India or they could take Taiwan, they would have long ago. They wouldn't have waited for, some opportune time or what. No, they would have done it. They simply don't have the military, and they have too many far economic risks at hand for them to be adventurous like that.
Yeah. So let's talk about.
Can I just say something real quick on this? Because Albert, I 100% agree with you on this overblown wargaming stuff. Because last May I chaired this U.S.-China event at the Rand Institute. I had a bunch of geopolitical experts and panelists and whatnot, and everybody's like wargaming every scenario. And I basically said, look, I honestly, I have this view that the biggest risk is what I call the gray rhino risk of a peaceful reunification, bloodless coup type scenario. And it comes from the standpoint of, comes from this conversation I had with a family friend maybe a couple of years ago who served in the KMT, just like my father did once upon a time. And growing up, I was born in Taiwan, but moved to the U.S. when I was like 4. But I grew up hearing the stories of how bad the Communist Party was and blah blah blah, and it was a shock for me to hear that somebody who served with the KMT would say, well, you know what, if push came to shove, we'd lay down our arms. We would welcome the embrace of China. I said, wait, what am I hearing here? And it basically comes down to this: the pro-democracy party within Taiwan, right, wants to disavow themselves of their Chinese heritage and basically say, hey, we don't even want to be thought of as ethnically Chinese, and we want to be democratic. To the old guard, to the KMT. By the way, why this is relevant is because the people that are in charge of the Taiwanese military are mainly KMT. And so for them to basically take this view that, hey, we would rather be in China's embrace than to be thought of as not Chinese. That to me is that I call that the gray rhino risk. Gray rhino meaning it's a risk that we all know about, but is completely poo-pooed. And to me, I think that is the much more plausible scenario than a kinetic invasion.
But Michael, what you're talking about with the cultural identity, Americans can't understand that. We cannot understand.
That's exactly right.
Except, and I don't
That's
care
exactly
what race
right.
you are in America, it doesn't matter. We just can't understand how deep that heritage goes and how deep that history goes. And let's not forget, and we don't have time to go into a whole history lesson, but Chiang Kai-shek was a dictator, right? The KMT was not a democracy lover. There were no elections in Taiwan until the early 1990s. So to position this as a democracy versus totalitarian discussion, that's a relatively recent discussion in the China-Taiwan debate, right? And so, there's a long history there, but I think what you mentioned about culture and race and other things for KMT supporters, that makes a lot of sense. And people here, people in the West, very hard for them to understand how long and how deep that goes.
The only other scenario I would say that would be a threat that for China to actually have a kinetic war with Taiwan is if the yen decided to go past 200, and I think that at that point the Chinese economy would be in such dire straits that Xi would have nothing else to lose. Nothing.
So would Korea. So Korea
Yeah.
would be in a shambles too, right? So
yeah.
let's move on to a couple of other things. I'd love to talk about China for the next 3 hours, and we could do it. But let's move on to a couple of other things. Mexico and India had some election results this year. We have this Claudia Sheinbaum, far left person leading Mexico with a legislative majority. First, what does that do to the regionalization hypothesis for manufacturing from the US? Does that endanger it, or is it just kind of a shoulder shrug and move on?
I do think that it endangers it. At least the perception of it endangers it. Similarly to India, the Mexicans have expanded their production because the exodus out of China, right?
Right.
The issue we have here, and shown in both elections and how the markets reacted, is these ESG policies, climate activists, so on and so forth, and specifically the MMT style of fiscal policies happening across the world right now is really making investors nervous. And I think at this point, it's either one or the other. Either you go back to pure capitalism, or you go into this like communist light MMT style, and obviously you see what happens when far left candidates get voted in.
Because with MMT, currency is just like a carnival fun ticket, right? I mean, it's
yeah,
not really currency.
that doesn't mean anything. It's just a line item. Like, yeah, sure, okay. Well, things matter at some point. Physics takes over, math takes
value.
over.
Yeah. Okay, good.
I think I was just going to say, as far as the oil and gas industry that has been fledgling already in Mexico for years because of a multitude of problems going on. I mean, you just elected a climate scientist. So, I think that if you're involved in that industry, you should be very wary of what may happen to that industry in general.
Yep, things are stacking up for Texas to do really well. So, so let's talk
Yeah,
about
everyone should move there.
move to Florida where the beaches are beautiful. So let's talk a little bit about India, Albert. You mentioned India as a potential manufacturing alternative to China. They've been moderately successful with that. With the change, I would say Modi still in control, but the consensus basis now that they have to negotiate tells me that there may be more regulatory and bureaucratic imposition on new investors in India. Is that a valid worry, or am I just projecting?
I don't think it's that much of a worry. I mean, if you compare the Chinese legal system to the Indian legal system, I would choose the Indian legal system all day long, even with like any kind of perceived warning signs, with Modi's coalition being not as strong as they expected it to. We've talked about this so many times. It's like, the Indians are so well poised to take all the excess manufacturing away from China. The problem they have is infrastructure going into the center of the country, and that's going to take decades to resolve.
Yeah, they've had a huge amount of investment in infrastructure, especially, partnering with the Japanese and others, but it's still not really there. The other concern I have about India is, they have these huge industrial conglomerates, Reliance and Tata and other guys. My worry has been with the small and mid-sized manufacturers being able to grow up into those global, like the, Mittelstand in Germany, right? It seems like the regulatory weight that those small and mid-sized companies have to carry in India is almost too much of a burden for them to be globally competitive. What do you think about that?
Yeah, I mean, I don't know about that, Tony. I mean, I think the biggest problem that the Indians have is a cultural thing, how they act just like the Chinese in trade, specifically companies like Reliance. They go to the Middle East and they kind of, shaft a lot of like the smaller commodities brokers and whatnot. And that's a common thing that the Chinese have done over and over again. And I think what the Indians need to do is really be wary of, relationships concerning trade going forward, specifically in the Middle East.
Yeah, I mean, it's very, very nationalistic practices, right? I mean, the US is concerned or criticized all the time about rising nationalism, but these people have never really been to Asia to see Japanese nationalism, Korean, Chinese, Indian, and so on. I mean, it's a whole new level of nationalism in trade, in government, in political messaging, and other things.
It's ingrained in their culture, and that's something that the Westerners don't really understand.
Yep. Okay, and then Albert, one last question about in terms of geopolitics. Do you sense that there's a perceived, say, growing risk-off attitude toward emerging markets? And if so, does that help both the dollar and US equities?
That's really a question for Michael at the moment.
Both, okay, yeah.
It's the U.S. I mean, I can paraphrase it and Michael can take over, but I mean, it's the U.S. wrecking ball at the moment. And in my view, the U.S. dollar is a tool to combat inflation that Janet Yellen willy-nilly uses. I think it can have severe repercussions, in the next, 5 to 10 years. But that's something that, Michael spoke about multiple times over the last 12 months, I believe.
Yeah. I'm just looking at how beautiful that Florida street is and how welcoming it would be for a bunch of Californians. Michael, what do you think about the EM, the potential risk off from EMs, and does that bolster the dollar, bolster US equity?
I'm very heightened to this risk because I started my hedge fund career in 1997, right when when Thailand first devalued its baht. I was actually on honeymoon in Southeast Asia when that happened. And then a year later, right, I remember like when I was in Bali, the rupiah had devalued to something like 2000, And then I just would not have ever believed that a year later it would go to 18,000. And
Did you buy an
I,
island?
yeah. So the these lags these lags from like the proverbial butterfly flapping its wings can be very, very long. If you've read, I highly recommend this book by Russell Napier called The Asian Financial Crisis that talks about the origins of it. And really the seeds were sown as early as like late 95, early 96. And it didn't culminate in this spectacular crescendo that resulted in LTCM blowing up and Russia defaulting until the end of 1998. So I think even though the DXY, everybody pays attention to the DXY is only at 104. But if you look at what has happened against these EM currencies, Egypt, Nigeria, Argentina, I mean, it's pretty. These are pretty spectacular devaluations, and so the yen is the only G7 currency that is looking really, really dicey. And I agree. Like if the yen goes to 180, forget 200, if it goes to like 180, there are going to be serious problems. And it's not just the yen, by the way. You look at the chart of the Korea won against the dollar, very similar type of chart. So China is boxed, and China to me is the big kahuna, because if they are unable to Brian McCarthy actually thinks that the pressures have been building so long that they cannot manage a gradual devaluation. Like if they even let small cracks appear, the whole thing breaks down, and then you have like
communications are so bad. They're so bad. They botched in 2015. They'll botch it again. If you can't trust your central bank, you can't trust your currency, and you can't trust your economic data. So PBOC, I mean, I've said this before, these guys practice numerology in their announcements. And so you have no idea how the decisions are made, and there's no transparency.
Yeah, that's right. That's right. And so all this, no geopolitical discussion would be completed without addressing BRICS and the de-dollarization, the ridiculous de-dollarization arguments. And I basically say that, okay, well, show me, not only do you have to have a liquid currency, what's lost on a lot of the BRICS people is that you need to have, at the end of the day, a very deep liquid bond market to park those reserves in.
Yeah.
And there's just no contender. There's just not even a close contender to the US dollar ecosystem.
Yep. I'm not buying.
Yeah, that's something that when you pose that question to people that talk about the death of the dollar and de-dollarization and gold backed whatever, they don't have an answer. They just said, no, the dollar's just dying. Okay, well, tell me exactly what's replacing it. Oh, but we don't know. Well, just the dollar's dying. Okay, well then, you're not really a serious person. It's just ludicrous. Right. There's no competitor for it's not even just the ecosystem, right? But there's so many more components, like legal frameworks, military power projection, so on and so forth, that goes into a reserve currency status that just no one wants to address. They just say dollar's dying. Yep. They leave it at.
So I'm going to segue here and say Tracy Shuchart was on Fox Business yesterday talking about the dollar. And Tracy, what was your statement about the dollar yesterday?
I said, not in our lifetimes are you going to see it?
That's right. That's right.
That's really what I said. I said, yeah, we're seeing cracks, might be, but we're still 48% of global transactions globally. It's the reserve currency. You can't compare it to, the euro or whatever, because the whole segment was about, we're seeing an uptick in gold as reserve assets for central bank, as opposed to currency, and its gold reserves are almost equal to the euro. And, you can't, that's apples to oranges. The euro is not a reserve currency. So I was comparing two entirely different things.
Yep.
And not only that, I want to point something out really important here about gold, because gold can be considered one type of reserve asset, but it's a highly inelastic reserve asset. And so so here's the problem, right? So if you look at what happened during Asian Contagion 1.0 when everybody devalued, gold went down. Gold went down. Most people don't know that. Gold went down. And you know what I think is the reason for that is because at that point, our yield curve was normally shaped and longer term yields were much higher. And I think that was a big reason for why I guess U.S. Treasuries at that point were comparatively much more attractive than they are now. So my hypothesis is that if the Fed is truly boxed in here, and God forbid if they actually cut early, the bond vigilantes come and force long end yields higher. If long end yields go high enough, the entire precious metals as reserve asset, as the solution to de-dollarization, that whole trade will completely fall apart.
Yep. Very interesting. So Tracy, let's talk a little bit more about gold. Okay, so we've got gold up about 15% year to date, something like that. Silver is up about 27% year to date. A lot of people seem happy about it, and as Michael talked about, that could, potentially, fall apart over the long term. So, why are we seeing this? I mean, I think a lot of this started with people in China afraid of CNY deval moving into gold, but even with elevated prices, demand is still expected to outstrip supply this year pretty dramatically. So can you talk to us, especially with silver, because we've seen the rise in silver, can you talk to us about the supply gap in silver?
Yeah, I mean, I think you need to separate the two. I think everybody lump them as in, a store of value. It's gold and silver. But you have to realize that 45% of silver usage is used for industrial purposes, right? And so, and that includes chips, like NVIDIA chips.
Yeah.
That we're all gung-ho AI right now. You want 1 million chips, and NVIDIA is talking about they're upgrading their chips every year, so it's not like they can just make a stockpile and then they're going to sell them. They're talking about they want a new chip every year, right? And so that's a lot of supply that you're going to need. In addition to electric vehicles, they have a lot more electrical components, that there's a lot more silver in those vehicles. Also solar panels, also wind turbines. So I kind of separate those two. And, if you look at the silver, the World Silver Council, they came out and we're going to have negative 265 million ton deficit this year is what they forecast. And so I think that, really, I like silver over the long term. If we're going to, if everybody's gung-ho for these green goals and AI is here to stay, then we're going to need a lot more silver. So I think that's kind of where you kind of need to separate gold and silver. I agree with Michael 100%. The gold trade could, if you see it change in the long end, gold's probably going to sell off massively again. It's hanging in there right now. I think we've got central banks buying. They don't care what price they're buying at.
Right.
You've got geopolitical risk. You've got uncertainty about the US and the EU basically confiscating Russian funds. I think that's
right.
Making central banks a little bit wary of, what if I piss off my allies?
Right.
Are they gonna freeze my funds? So I think there's a lot of reason behind the gold trade right now, but that could change. That could easily change. I agree with Michael on that.
Right. And I'll remind you.
Can I play devil's advocate on one theme though? I haven't done the deep supply demand analysis you have on silver, but I'm thinking from a big picture standpoint that, so if you think about China's top-down directives, right? It was real estate for decades, and now that's run its course, I think of China's economy as kind of like a manufacturing line that cannot be turned off because they need to keep GDP at a certain level to keep people employed, right? So they directed it to homes. And now that they can't do that, right, that assembly line has been directed to what I call the Gretaverse, right, the green energy stuff. And so you're already seeing sort of pushback from the West on that. So I just wonder whether or not this green energy demand narrative for metals like silver and copper, I wonder whether these are overhyped and are subject to some disappointment, given a potential glut coming from just this runaway assembly line being now directed to that sector.
I think that's a fair hypothesis. I think we have seen a lot of pushback, especially on Chinese EVs in Europe and the US. And we're seeing wind and solar projects canceled all over the place because interest rates are high and people can't afford them anymore, and subsidies are being dialed back and so on. So I think that's a fair question to ask. Tracy, do you want to?
No, yeah, absolutely. I'm actually glad to see a pushback. I'm actually glad to see some sort of sense come into the energy policy world, because I think that people were aiming too high, and it was, take Germany for example. Practically destroyed Germany. They were like our case in point for this. And so, for me, I think it's, I'm glad to see a little bit of pushback and some cooler heads kind of back into the energy policy world. But again, I just don't see that, I just don't see the push stopping at any time. And really, I think the whole AI push is even bigger than the solar wind kind of push. So, we'll see what happens, but, definitely, I'm glad to see some sense back into some energy policy, and nat gas is back into the mix, where, in Europe, they wanted to, rule out nat gas entirely. You had just had Germany come out today. They want 2 new LNG facilities. So obviously they're not getting rid of natural gas anytime soon. And so I think this is headed into the right direction, and us not into disaster zone.
Right. Tracy, I do want to, since you mentioned kind of fossil fuels, I want to go back into OPEC. We covered a few things about OPEC, but it was a pretty big meeting. So what did we miss? We had a discussion earlier, but what have we missed in OPEC that you're paying attention to coming out of that meeting?
I think really, the first part was quite simple. The 2 million barrels per day that the group as a whole, that's OPEC plus, is going to continue to the end of 2025. And so that was kind of the easy part. And where the kind of tricky part came is with these voluntary cuts from the 8 nations. And so those are expected to continue throughout Q3. And then they're going to taper off over the next 18 months. That said, it comes with a caveat we were talking before, where, depending on market conditions, they could completely decide to, either stop or reverse this taper schedule that they sent out. And so, you had Saudi oil minister that day come out and re-emphasize that, this is subject to market conditions. Again, today he was out again, reiterating that statement. So to me, that says that they're probably not going to be able to go through with this, at least not until next year, perhaps. But it did spook the market a little bit, and thought, oh no, which in and of itself is a problem too, because if the market's that spooked over a taper of cuts, then that means the market's still very uneasy where we are right now.
Right. Do you think that there's any probability that the Saudis get tired of all this cheating from UAE, Russia, Iraq, and basically just go scorched earth like they did during COVID?
2020. I think that I don't think they will because of how in debt they are right now with the projects that are going on. They were not
That's
as
always been the case, though. I mean,
not in 2020 they were not as in debt as they are right now, and not so I think that is always a risk, yes, but I have said since 2020 I think they have learned their lesson. This is just my opinion, and they've seemed very cohesive as a group, even though we've had some cheating going on. They still reiterated their commitment to the group, and each meeting they try to get the other nations to kind of get back in line, like kind of whip them a little bit, say, hey, get back in line. So, I don't foresee that right now, but, obviously anything could change. And I think you would be able to see that. I think there'd be signs of that within foreign policy, and you would see headlines where they were starting to butt heads and things of that nature. And so right now, I think that I think they're pretty committed to this.
You've seen some rhetoric like that, though. I would argue that I mean, MBS does not like to be played for a fool, and these so-called voluntary cuts from Russia, and then also just like the flagrant cheating by UAE basically for the better part of a whole year now.
Well, they got an extra 300,000 barrels per day for 2025 because they were already there anyway. So, and of course you have problems in Iraq too as well. It's a very fluid situation, but again, I feel like the group is cohesive, and I don't think they're gonna go scorched earth unless they get really upset with the US.
What's concerning to me, though, is that the voluntary cuts are still in place even as the world goes into a slowdown.
Right.
And so I think we saw the reason why they went scorched earth in COVID was, Russia wasn't playing ball, and they basically said, all right, well, you know what, two can play at this game. We're going to go completely scorched earth until you cry uncle, and then it becomes like a game of market share, right? We know that oil revenues are revenues equals price times volume. Well, if price drops because demand drops, then they're gonna have to jack it up, make it up for in volume, and that's a nasty, vicious circle that we've seen before.
Oh, absolutely, and I'm not saying it can't happen again. I just don't foresee that. That's not my forecast right now from what I can decipher from examining this group in general. But like I said, it is the oil industry. Things can change on a dime. That I know that. So
Yeah, anything can change quickly. So guys, thank you so much. This has been a very deep, very broad discussion. I'm grateful for your thoughts on this. Thank you so much. Have a great weekend and have a great week ahead. Thank you so much.
Thanks for doing this. Great. It's been great.